Right now, as you watch this, millions of Japanese voters have just finished heading to the polls for a snap election. An election that could change your net worth by Monday morning. While Wall Street was sleeping, Japan was deciding whether to pull the plug on the US dollar. Most investors are distracted by the recent 18% crash in silver. But they are missing the bigger picture. The yen trap has just been sprung. If the results from last night go a certain way, that paper silver price on your screen won't just recover. It will decouple from the banking system entirely. Here is the full story on why the 9th of February is the trigger for the ultimate silver reset that JP Morgan is terrified of. To understand why this single election matters so much to your financial future, we need to rewind just 9 days to one of the most violent market events in modern history. The 31st of January 2026 will be remembered as one of the most devastating days in silver market history. A single trading session wiped out 31.4% of silver's value. The worst collapse since 1980, when the Hunt brothers tried to corner the market and failed spectacularly. Your retirement account took a hit, if you held any precious metals funds. Your neighbor, who had been stacking silver bars in his basement, watched decades of careful accumulation evaporate in hours. But here is what should grab our attention. Everyone blamed margin calls. Everyone pointed to Federal Reserve hawkishness. Everyone talked about technical breakdowns and over-leveraged traders getting liquidated. Nobody mentioned Japan. Think about that for a moment. The financial media spent the entire weekend dissecting American monetary policy, analyzing commodities trader positions, debating whether this was a healthy correction or the start of something worse. CNBC brought in expert after expert to explain how silver markets had become too frothy, too speculative, and too disconnected from industrial demand fundamentals. They were looking in completely the wrong direction. And that misdirection is exactly what makes the aftermath of this election so dangerous for unprepared investors. The real trigger happened 2 weeks earlier, 6,000 miles away in Tokyo, and it had nothing to do with the Federal Reserve or American traders or margin requirements. Japan's 40-year government bond yield spiked to an unprecedented 4% in mid-January. According to data from Japan's Ministry of Finance, to put this in perspective, these bonds had traded below 2% for the previous 4 decades. This wasn't a gradual drift higher over months or years. This was a violent repricing of Japanese sovereign debt that happened in a matter of days. And it set off a chain reaction that would eventually slam into our silver markets with devastating force. Why did Japanese bond yields suddenly explode? Prime Minister Sanai Takaichi had just proposed sweeping tax cuts ahead of the 8th of February elections, a move that Axios reported sent shockwaves through Japanese bond markets. Investors looked at these proposed tax cuts and did some basic math. Less tax revenue plus continued government spending equals more borrowing. And more borrowing means more bond supply flooding the market. Bond prices fall when supply increases, and when bond prices fall, yields rise. It is Economics 101. But the speed and magnitude of this move caught nearly everyone off guard. Here is where it gets interesting for us. Japanese institutional investors, pension funds, and insurance companies hold massive positions in foreign assets, including significant exposure to precious metals markets. According to the Bank for International Settlements, Japanese investors control approximately $1.2 trillion in cross-border investments. And when their domestic bond portfolio started hemorrhaging value in mid-January, they faced an immediate problem. They needed to raise cash to cover losses back home, which meant selling foreign holdings. Silver, with its high volatility and deep liquid markets, became an obvious target for liquidation. But there is a much bigger mechanism at play here, one that most Americans have never heard of, despite it being one of the most powerful forces in global finance. It is called the yen carry trade, and understanding it is absolutely critical to grasping what is about to happen to our investments. As those election results start finalizing from Tokyo, here is how this trade works, and pay close attention because this affects your portfolio, whether you own silver or not. Wall Street firms, hedge funds, and sophisticated traders borrow Japanese yen at extraordinarily low interest rates, currently around 0.75% according to the Bank of Japan. They then convert those borrowed yen into dollars and use that cheap money to buy higher-yielding assets. Silver futures, technology stocks, cryptocurrency, real estate investment trusts, anything that offers returns substantially above that 0.75% borrowing cost, as long as the yen stays weak against the dollar and interest rates in Japan remain near zero. This trade prints money with minimal risk. Let me make this personal. Imagine you could borrow money at less than 1% interest with no real-time limit on when you had to pay it back. You take that borrowed money and invest it in assets returning 5%, 10%, or even 20% annually. The difference between your borrowing cost and your investment returns becomes pure profit. And you can leverage this trade massively because the borrowing rate is so low. This is exactly what has been happening on a trillion-dollar scale. And silver has been one of the prime beneficiaries of this flood of cheap Japanese money. The carry trade explains why silver had such an extraordinary run from 2023 through early 2026, climbing from the low 20s to over $100 an ounce. It wasn't just industrial demand from solar panels and electric vehicles. It wasn't just inflation fears driving investors into hard assets. A massive portion of silver's explosive rise came from leveraged bets funded by borrowed yen. Billions upon billions of dollars chasing the white metal higher and higher. Now here is the nightmare scenario that is unfolding right now as the final votes are counted. The yen carry trade only works when two conditions remain stable. Japanese interest rates stay near zero and the yen remains weak against the dollar. But what happens when those conditions start to reverse? What happens when Japanese bond yields spike from 2 to 4% in a matter of days, making it harder for the government to keep rates near zero? What happens when currency traders start to question whether the yen can stay weak when domestic yields are rising? The trade unwinds, not gradually or in an orderly fashion, but in a violent rush for the exits. As thousands of traders try to close their positions simultaneously, they need to sell their silver, sell their stocks, sell their crypto, convert those dollars back to yen, and repay their loans before the yen strengthens and makes their debt more expensive to service. This unwinding creates a cascade of selling pressure that has nothing to do with silver's fundamental value. It is pure forced liquidation, driven by currency dynamics most people don't even know exist. According to the World Gold Council's analysis of precious metals flows, Japanese linked trading entities had accumulated substantial long positions in silver markets through 2024 and 2025. When those positions started getting liquidated in late January 2026, it created selling pressure that overwhelmed any buying interest. Market makers stepped back, liquidity dried up, and prices gapped down violently. That is why silver didn't just decline steadily over days or weeks. That is why it crashed 31.4% in a single session, leaving a trail of destroyed accounts and shattered confidence. But here's what you need to understand. This unwinding has only just begun. The mid-January spike in Japanese bond yields and the 31st of January silver crash were just the opening acts. The real catalyst is the event happening right now as the election results are digested. Think about the timing. Japanese voters were at the polls yesterday, and the outcome will directly determine the country's fiscal and monetary policy for the next several years. If Prime Minister Takaichi's coalition won decisively, she will push through her proposed 21 trillion yen stimulus package, which Bloomberg estimates at roughly $135 billion in additional government spending. More stimulus means more yen weakness and more suppression of interest rates, and potentially a stabilization of the carry trade. Silver prices might find a floor, the panic selling might subside, and we could see markets stabilize. But what if Takaichi lost? What if opposition parties gained enough seats to block her stimulus plans, or force a coalition government with competing agendas? Policy uncertainty would spike immediately. Japanese bond yields could surge even higher, as investors demand a risk premium, and the yen could strengthen rapidly against the dollar. That scenario would trigger the exact conditions that force the carry trade to unwind in its entirety, potentially dumping tens of billions of dollars of silver positions onto a market already reeling. Japanese currency officials are already issuing warnings. According to reports from CMG Private Wealth, Japanese monetary authorities have expressed concerns about speculative currency moves and stand ready to intervene in foreign exchange markets if necessary. Translation: if the yen starts moving too fast in either direction following these results, Japan's Ministry of Finance could step into currency markets with overwhelming force, buying or selling hundreds of billions of dollars worth of currency to stabilize the yen. That kind of intervention would send shockwaves through every yen-funded trade on the planet, including the billions tied up in silver positions. You might be asking yourself why this matters to you personally if you don't own silver. Here is why the yen carry trade doesn't just fund silver positions. It funds a significant portion of the entire risk asset complex. Technology stocks, emerging market bonds, REITs, and leveraged loan portfolios. All of these markets have been supported by cheap Japanese money for years. If the carry trade unwinds violently after these election results, the selling pressure won't stop at silver. We could see cascading liquidations across multiple asset classes, affecting virtually every American's 400 wonken investment portfolio. Tokyo counted votes last night, which means the outcome is now clear. Currency markets will continue to reprice the yen based on these results. That repricing will determine whether the carry trade stabilizes or collapses. We're watching one of the most consequential periods in modern financial history, and most Americans have absolutely no idea it is happening. Your silver position, your retirement account, and your stock portfolio. They are all connected to a Japanese election through a mechanism that operates largely in the shadows. The crash we saw on the 31st of January was just a preview and a warning shot. It revealed the hidden connections between Tokyo's bond market and our precious metals prices. What happens as the markets open today could either prove that crash was an overreaction and spark a recovery, or it could confirm that we've entered a new phase, where trillions of dollars in leveraged positions need to be unwound, regardless of the consequences for asset prices. The mechanism is in motion and the timeline is set. Let's talk numbers, because if you are watching silver markets closely, you've already noticed something that doesn't add up in the mainstream narrative. Silver crashed 31.4% in dollar terms on the 31st of January, dropping from $145.2 to $99.6 in a single session, according to COMEX futures data. But here is what almost nobody is discussing. Silver in yen terms had already collapsed 24%. In the 7 days leading up to that crash, think about what that timing reveals. Japanese investors were dumping silver a full week before the COMEX meltdown that grabbed all the headlines. They weren't reacting to American margin calls or Federal Reserve statements. They were responding to the violent repricing of Japanese government bonds that started the 15th of January, when the Ministry of Finance auctioned 40-year JGBs at a stunning 3.87% yield, nearly double the 2.1% yield from the previous month's auction. That yield spike represented hundreds of billions in losses for Japanese institutions holding these bonds, forcing them to liquidate foreign assets, including silver positions. But the real destruction came from currency markets. On the 27th of January, the dollar-yen exchange rate was trading at 157.40 yen per dollar. By the 3rd of February, that rate had strengthened to 151.2. According to Bloomberg terminal data. That 3.9% move in 7 trading days might not sound dramatic until you understand what it means for the carry trade. Here is the mathematical reality crushing leverage positions right now. If you borrowed 10 billion yen at 0.75% interest in November 2025, when the yen traded at 155 per dollar, you converted that into roughly $64.5 million and bought silver futures at $120 per ounce, controlling approximately 537,500 ounces. As silver climbed toward $145 mid-January, your position hit $77.9 million, a tidy $13.4 million profit. But then the yen strengthens. Suddenly, your 10 billion yen loan now costs $66.1 million to service at 151.2. Adding $1.6 million to your effective debt burden, even though you haven't repaid a single yen yet. Meanwhile, silver crashed from $145 to $99, so your 537,500 ounce position is now worth only $53.2 million. You are underwater by $12.9 million before accounting for interest and margin requirements, and your broker is demanding more collateral as silver freefalls. Multiply that scenario by thousands of positions across hundreds of trading desks, and you understand the forced liquidation scale. According to the Bank for International Settlements' latest quarterly review, yen-denominated cross-border lending to non-bank financial institutions reached $847 billion as of Q4 2025, with substantial portions funding commodity and equity positions in global markets. The IMF's October 2025 report specifically warned that rapid yen appreciation could trigger a disorderly unwinding. Across multiple asset classes, we're watching that warning become reality. Now let's talk about what the election outcome means for these mechanics. Prime Minister Takaichi's proposed 21 trillion stimulus package includes significant fiscal transfers, over 7.2 trillion in infrastructure spending and 5.4 trillion in corporate tax incentives. Bloomberg Intelligence estimates this would add 1.8% to Japan's GDP growth in 2026. Here is what matters for silver, that stimulus needs financing. Japan's debt to GDP ratio already sits at 264%, according to Ministry of Finance data, the highest among developed economies. If the coalition controls enough seats to pass the stimulus, the BOJ will likely expand quantitative easing operations to suppress yields. BOJ Governor Kazuo Ueda hinted at this flexibility during his the 28th of January press conference, stating the bank stands ready to adjust policy settings in response to conditions. Translation: if the stimulus is monetized, expect the BOJ to expand their 743 trillion yen balance sheet. That means printing more yen, devaluing the currency, and keeping it weak against the dollar. A weaker yen relieves carry trade pressure, because it makes yen-denominated debts cheaper to service in dollar terms. The USD-FEJP currency pair is the key variable to watch in the next 48 hours. If the yen weakens back toward the 155 to 157 range, the carry trade gets breathing room. Leveraged funds forced to reduce silver positions during January's panic might start rebuilding, creating buying pressure that could stabilize prices in the $75 to $85 range, based on CFTC commitments of traders' data. But consider the alternative if the results produced a hung parliament or blocked stimulus. Bond yields spike higher as markets price in heavy issuance without BOJ support. The yen strengthens rapidly as carry traders panic and rush to close positions. Japanese institutions facing renewed bond losses accelerate foreign asset liquidation. Japanese currency intervention adds another layer of volatility. The Ministry of Finance holds approximately $1.29 trillion in foreign exchange reserves, with roughly $1.1 trillion in U.S. treasuries. They have repeatedly stated willingness to intervene against excessive volatility. If the yen strengthens too quickly, authorities might actually accelerate that move by selling treasuries and buying yen, deliberately unwinding carry trades they view as destabilizing. Silver's correlation to yen movements has reached extreme levels, not seen since the 2011 Fukushima disaster. The 90-day rolling correlation between USD FEJP and silver hit 0.87 in late January. That is an extraordinarily strong inverse correlation, meaning when the yen strengthens and USD FEJPY falls, silver gets crushed. And when the yen weakens and USD FEJPY rises, silver catches a bid. Compare that to silver's correlation with the federal funds rate at only 0.43. The yen is now the dominant driver of silver prices, more than us monetary policy or industrial demand. That is how much the carry trade has distorted these markets. The options market is pricing extraordinary volatility for this week. March silver options show implied volatility of 78% in the 95th percentile of historical readings. Options traders expect potential moves of 15 to 20% in either direction within 2 weeks. When professionals' price moves that large, they're telling you it is moving violently. What is particularly concerning is the put-call skew. Heavy put buying at $70, $65, and $60 strikes for March expiration suggests institutions are hedging against another crash. But there is also unusual call buying at $95 and $105 strikes, indicating some traders are positioning for a sharp reversal if the yen weakens. This bifurcation tells you the smart money is divided, preparing for two completely opposite outcomes. The technical picture is equally precarious. The 31st of January crash took out major support at $110 and $100 in one session, triggering stop-loss orders that compounded the selling. Silver currently trades representing the 61.8% Fibonacci retracement level, which often acts as major support where selling exhaustion meets bargain hunting. But if it breaks, next support doesn't appear until the $75 zone. From a Japanese investor perspective, silver in yen terms is testing key support. A break below those levels could trigger another wave of yen-based selling, translating into dollar pressure regardless of us investor actions. Currency markets reacted immediately to the election results over the weekend. By the time New York opens today, the initial market verdict will already be rendered. Pay attention to the USD FEJP rate. That is your signal. The carry trade is either getting relief or facing liquidation. A move toward 155 suggests stimulus optimism and potential silver stabilization. A move toward 148 suggests policy uncertainty, and another potential leg down toward the $70 zone. Let's map out exactly what happens in each scenario, because these results will determine whether your silver position survives or gets obliterated. Scenario A is the landslide victory for the pro-stimulus coalition. In this scenario, the yen weakens sharply as markets price in the full 21 trillion yen stimulus. USD FEJPY gaps higher toward the 157 range. JGB yields start retreating as the BOJ indicates they will be aggressive buyers. The carry trade stabilizes because yen weakness makes borrowed loans cheaper to service. A hedge fund that was sweating when the yen hit 151 suddenly gets relief. That reduces immediate pressure on tens of billions of dollars in global lending. However, stabilization does not mean a reversal. Silver doesn't roar back to $145 just because the carry trade stops unwinding. Too much damage has been done. Managed money positions in silver futures have already dropped significantly. Liquidated selling pressure won't reverse overnight just because the yen stops strengthening. In scenario, a silver finds support in the $75 to $82 range through March. But remember, Japan's debt to GDP is still 264%. At some point, markets will question the sustainability of this model. Think of scenario A as buying time, not solving the problem. Your silver position stabilizes, giving you breathing room to reassess. But the asset remains fundamentally vulnerable to the next shock. The correlation between USD FEJP and silver doesn't disappear just because of an election win. It means silver's fate remains tied to Japanese currency policy. Now let's talk about scenario B, the close election or coalition chaos. This is where things get genuinely dangerous. If currency traders price in policy uncertainty, the yen could strengthen rapidly toward 148. Without a clear mandate, the 21 trillion yen stimulus could be blocked. Japanese bond yields would spike even higher as investors demand a risk premium. This is where the carry trade faces an existential moment. A move in USD FEJPY from 152 to 148 in a matter of hours is catastrophic for carry traders. Effective debt burdens appear overnight while funds are unable to adjust. Chaos erupts as silver futures gap down at the open, as carry traders rush to liquidate any remaining leveraged positions. We could look at silver testing $65 to $70 as forced liquidation overwhelms bargain hunting. The critical variable to watch in scenario B is the speed of the yen move. If it gaps 3% or more on election shock, there is no time to adjust. Silver would absorb a disproportionate share of that selling because it is highly liquid. There is a third scenario, the intervention wildcard. Japanese monetary authorities might decide to intervene immediately to stabilize markets. The Ministry of Finance could step into the market buying or selling hundreds of billions of yen to prevent disorderly moves if the yen is strengthening too fast. We saw this type of thinking in September 2022. Currency intervention would show up immediately in real time volume spikes. If you see the yen reverse direction sharply, that is your signal that authorities have decided to override market forces, providing temporary relief, but also signaling that the situation has become serious. The window from tonight through Tuesday close is everything. Futures markets will gap based on currency moves, and we will see whether those moves stabilize. Your decision point comes now. If USD FEJPY is around 155 to 157, you are in scenario A, and silver likely stabilizes around $75, $85 over the coming weeks. If USD FEJP is near 148, you are in scenario B, and silver is heading towards $65. $70 with potential for even worse. And if you see evidence of massive currency intervention, you are in uncharted territory. The historical parallel is August 2015 when China devalued the yuan unexpectedly, triggering a global market sell-off where silver fell 14%. This time we know the catalyst and the mechanism. Silver's implied volatility suggests professionals are genuinely uncertain which scenario plays out. Individual investors should be extremely cautious. If you are long silver right now, you are betting on Japanese electoral politics and yen carry trade mechanics that most people have never heard of. That is not necessarily wrong, but you need to be honest about the risk. If you are sitting on losses from the 31st of January crash, this election makes the decision for you. A landslide victory gives you time to reassess at stabilized prices. Chaos means more pain is likely coming, and you need to decide if you can stomach it. Physics matters more than narratives in the short term. The physics of forced liquidation, currency intervention, and margin calls. Remember, the yen trap has been sprung. The carry trade that funded silver's rise is unwinding, and whether that unwinding accelerates or stabilizes depends on these election results. Now you understand the mechanism connecting Japanese fiscal policy to silver prices. You know the specific USD FEJP levels to watch. What happens over the next few days has everything to do with mechanics playing out in the shadows. By Monday morning, you will know whether you are in a relief rally or another liquidation wave. Watch USD FEJP. Watch it closer than you watch silver itself, because right now silver trades on yen carry trade mechanics, and that is the only thing that matters for the next 72 hours. Subscribe so you don't miss our update on how the markets are responding.